D.R. Horton Second Quarter 2026 Earnings Call Transcript Summary Introduction and Overview. D.R. Horton, America's Builder, reported solid results for the second quarter of fiscal 2026, navigating market challenges with a disciplined approach. The company generated $7.6 billion in revenues and achieved $867 million in consolidated pretax income, resulting in 11.5% pretax profit margin. Despite ongoing affordability constraints and cautious consumer sentiment impacting new home demand, DHI's experienced teams responded effectively, leading to net sales orders increasing by 11% year-over-year. A key highlight was the reduction in completed unsold homes by 35% compared to the prior year, demonstrating a strategic balance between sales pace, pricing, and incentives. Key financial metrics. Revenue. Consolidated revenues stood at $7.6 billion for the quarter. Home sales revenues were $7 billion, with 19,486 homes closed. Net income. Net income for the quarter was $648 million. Earnings per share. EPS diluted earnings per share were $2.24, compared to $2.58 in the prior year quarter. Gross margin. The home sales gross profit margin was 20.1%. This figure benefited from a 40 basis point positive impact from a favorable litigation outcome and lower than normal warranty costs. Excluding these, the normalized home sales gross margin would have been 19.7%, exceeding the guidance range. Average closing price. The average closing price was $361,600, down 1% sequentially and 3% year-over-year. DHI emphasizes its average sales price is significantly below the national average for new homes, highlighting their affordability focus. Net sales orders. Net sales orders increased by 11% year-over-year to 24,992 homes, with a total order value of $9.2 billion. Cancellation rate. The cancellation rate remained stable at 16% for the quarter, consistent with the prior year and down from 18% sequentially. SG&A expenses. Home building SG&A expenses increased 2% year-over-year, with SG&A as a percentage of revenues at 9.2%, up from 8.9% in the prior year, largely due to lower average sales prices. Management commentary and key statements. Paul Romanowski, President and CEO. The D.R. Horton team delivered solid second quarter results with consolidated pre-tax income of $867 million on $7.6 billion of revenues and a pre-tax profit margin of 11.5%. He emphasized the team's discipline in responding to current market conditions, particularly affordability constraints and cautious consumer sentiment. We continue to focus on capital efficiency to generate strong operating cash flows and deliver compelling returns to our shareholders. He highlighted $3.7 billion in cash from operations and $4 billion returned to shareholders over the past 12 months. Regarding incentives, he stated, "Our sales incentives increased during the second quarter, and we expect incentives to remain elevated for the rest of the year." He underscored DHI's commitment to leveraging its platform to provide affordable homeownership opportunities, noting 65% of their mortgage company's closings were to first-time homebuyers. Bill Wheat, Chief Financial Officer, CFO, he provided details on the financial performance, including net income and revenues. On gross margins, he stated, "We currently expect our home sales gross margin to be 19.7% or slightly higher in the third quarter, as we expect to realize additional construction cost savings on homes closed." He elaborated on SG&A, noting the ratio increase was driven by lower revenues due to declining average sales prices. He detailed the company's strong balance sheet, $6 billion of consolidated liquidity, and low leverage of 21.7%, with a target of around 20%. Forward-looking statements and forecasts. Third quarter 2026 outlook. Consolidated revenues are expected to be between $8.8 billion and $9.3 billion. Homes closed are projected to be between 23,500 and 24,000 homes. Home sales gross margin is forecasted to be in the range of 19.7% to 20.2%. Consolidated pretax margin is expected to be between 12.2% and 12.7%. Full year fiscal 2026 outlook. Consolidated revenues are now expected to be approximately $33.5 billion to $34.5 billion. Homes closed are projected to be 86,000 to 87,500 homes. The income tax rate is forecasted at approximately 24.5%. Operating cash flow is expected to be at least $3 billion. Common stock repurchases are projected at approximately $2.5 billion. Dividend payments are expected to be around $500 million. Significant risk factors. Affordability constraints. The primary risk identified is the ongoing impact of affordability challenges on consumer demand. Cautious consumer sentiment, broader economic uncertainty, and cautious buyer sentiment continue to influence purchasing decisions. Mortgage interest rates. Fluctuations in mortgage rates are a significant factor affecting buyer affordability and demand. Inflationary pressures. While currently seeing cost savings, potential future inflation, particularly from oil prices, is a monitoring point. Regulatory and legislative uncertainty. The build-for-rent segment faces uncertainty regarding potential legislative changes. Highlights: strong sales order growth. Net sales orders increased by a robust 11% year-over-year. Inventory reduction. Completed unsold homes are down 35% year-over-year, indicating efficient inventory management. Capital efficiency and returns. The company generated significant operating cash flow and returned substantial capital to shareholders through repurchases and dividends. Returns on equity and assets remain strong. Affordability focus. DHI continues to prioritize affordable price points, with a significant portion of closings to first-time homebuyers. Improve cycle times. Median cycle time from home start to close improved by nearly a month year-over-year, enhancing inventory turnover. Lot position. DHI maintains a strong and well-managed lot position, with a significant portion controlled through purchase contracts, enhancing capital efficiency. Regional performance. Good demand was noted in Texas and Florida, with consistent performance across most markets, though some markets with a heavy software industry exposure showed slight softness. Lowlights. Declining average selling price, ASP. The average closing price saw a slight decrease both sequentially and year-over-year, impacting revenue per home. Elevated sales incentives. The company expects sales incentives to remain elevated throughout the year, impacting gross margin. Increased SG&A ratio. The SG&A as a percentage of revenues saw a modest increase, primarily due to lower average sales prices. Lot costs. Lot costs remain a headwind, up 4% year-over-year, though expected to be offset by construction cost savings. Future outlook. DHI is focused on navigating the current market by leveraging its industry-leading platform, scale, and operational efficiency. The company remains committed to its disciplined, returns-focused operating model, prioritizing capital efficiency and shareholder returns. They will continue to adjust product offerings, incentives, and inventory levels based on market demand. The focus remains on delivering quality homes at affordable price points and enhancing long-term shareholder value.